be through the chat window. You will find by now and you will be familiarized by now with the chat window. Make use of the chat window to any of your questions. If you have any question during our speaker's presentation, just type it in the chat window and our speaker will answer them later on after the presentation. This CPD presentation is recorded and the slides will be provided a few days after the presentation date only to the actual attendees. Your attendance for full members, which is ASOC, MRICS, FRICS, will be automatically added to your planned CPD record. All you need to do is to log into your rics.org and post your learning outcome and save it. In total, you will have 1.5 hours of formal CPD. Unfortunately, for APC and ASO candidates, they have to manually enter that CPD hours through your ARC account. Now, for tonight, our speaker, his name is Tarek Madany. He's a registered RICS valuer and the managing director for Global Appraisal Tech. I will hand over to you, Tarek, who will discuss the topic for tonight's webinar.
All right. Hello, everyone. I guess we have run the poll. I see there's a mixed bag. We have 6 registered valuers. We have 13 candidates looking to become valuers, and there's about 8 people who have not been subjected to valuations before. So this is quite a spread, and I'll try to go. We have a limited amount of time, so I'll try to stick to the schedule. But by all means, if you have questions along the way, feel free to type them in the chat window, and then we'll address them in the questions and answers period. So it's also clear that the majority of the people here do not speak or understand Arabic, so we will skip any of the Arabic phrases, and we will focus on delivering the material according to the RICS standards. All right, I think we can end the polls. Thank you, Dine. So a little bit about myself. My name is, again, as Dine has mentioned, my name is Tarek Madany. I am an engineer by training, and I'm an RICS as well. I also have other credentials. I have an MBA, I'm a PhD candidate, and I have other credentials. I'm a certified valuation analyst in the ICVS. Currently, I'm the marketing director of a company, a local firm in Egypt named Global Appraisal Tech. And I've been doing valuations for the past 14 years. I have 2 children, and I frequent the UK because of my research work. So the topic objectives, today's webinar. By the end of the webinar, you are hopefully going to understand the 3 valuation approaches and the 5 methods included in the ICVS, IVS, International Valuation Standards, and the RICS, Global Standards. You're also supposed to, by the end of the webinar, you will know which specific valuation approaches that are best suited to which assets, hopefully, and then appreciate the relationship between something called the purpose of valuation, the basis of value, the approach used, and the methods used. And hopefully that will put you in a good understanding of the RICS standards in relation to the approaches and methods, and be able to assess the merits of various data available in the valuation approach and method selected. So Roy is complaining about my voice. Can you guys hear me well? Is there any issue with my sound? If it's echoey or all good, okay, I'll take your word for it, Claire. All right. So Roy, maybe you need to adjust your speaker. All right, so is everyone here familiar with the Red Book? So the Red Book is there's two Red Books, the UK-based one, and then there's the global standards, which is the ones that's used across the world. And if you guys are familiar with the Red Book, it's broken down into sections, and those sections are essentially called PS1 and PS2, which is the professional standards, PS1, PS2, and then the valuation practice statements, which is VPS1, VPS2, 3, 4, and 5, and then the FPGA, which is the guidance notes, there are 10 of them. And this is according to the RICS Global Standards 2017. For the scope of this webinar, I'm not going to go through all the steps, through all the components of the Red Book, but I'm going to be focusing on VPS 4 and VPS 5. So VPS 4 and 5, for those of you who are familiar, and for those who are not, talk about something called the basis of value, the assumptions and special assumptions. And then the VPS 5 speak about the approaches and methods to be adopted. Obviously, the standards, whether it's the IVS, so the IVS equivalent is 104 and 105, International Valuation Standards 2017. And both the RICS and the IVS do not talk about how to do the valuation, right? In terms of what are the steps, how to apply the standards. They just talk about the standards. So they say there are 3 bases, there are 3 approaches, or there's X number of bases, X numbers of approaches, and X numbers of methods. That's the definition of the approach, that's the definition of the method, etc. But I think it's up to us, the training in the academy, to help you, or through the training process, and if you have guys going through the APC process, to take enough training and exercises to learn how to apply those standards in real life. And hopefully today is just a taste of that, and it should be clear by the end of the presentation or the webinar what it is that you think you're comfortable with and what it is that you perhaps need more training on. So to step right into it, to jump right into it, there's a very important distinction that we have to make. So in the RICS, in valuation, some of you already know this, there's a distinction between price, cost, value, and worth. I wish this webinar was interactive, but in essence, a price is the amounts that's being asked or offered or paid for an asset. So if you have a real estate on the market, the owner is asking for a price, right? Or if a buyer is going in, he's looking for an asset at a certain price. So the cost, on the other hand, is a different concept. The cost is how much you would spend to acquire or create the asset, right? Develop it or build it. It could be the price, but it could be also just the material cost. And there's other factors that can be involved in the cost. Value is an estimate of a price. It's an indicator of the price that would be achieved. So for example, if an owner comes and says, my house is for $1 million, but the value could be $900,000. So there could be the price and the value could be different. And then the worth is something that is specific to a specific buyer or a specific seller. So it might be the market value, or something on the market might be $1 million, but to me, it's worth a lot more than that. Or it's not worth it at all. It's worth a lot less. That's specific to my needs, my accepted benefits that could be produced from that asset, from that capital investment. So price, cost, value, and worth are 4 different concepts. That sort of leads it into something called the valuation methodology framework, right? So we've developed this in the academy, in the RICS Academy, and in essence, it's a way to navigate a very complex decision and identification process for any valuer. Can you guys hear me well? Yes. Yes, the slides, Claire, will be provided to you. So the valuation methodology framework is consisted of, there's 4 components that you have to wrap your head around. And this is a very important introduction to the purpose of this webinar, which is to understand what methods to use and what are they. So the first thing you have to identify is something called the type of asset, right? So is it land, residential, commercial, is it a specialized building, is it plant and equipment? The second thing you have to identify is the purpose of the valuation, right? Why is that assignment coming in? Why is the owner coming in, or the company coming in, or whoever it is that's coming in and asking for a valuation? Why is it that they're asking for a valuation? Is it to obtain a loan from a bank, a mortgage, like something against securities? Is it to buy the property? Is it to sell it? Is it an insurance company that's coming in and asking to value a property? I.e., is it an auctioneer that's going into an auction, and so forth? Maybe it's a financial firm coming in and doing something called a price purchase allocation, right? Or it might be just a liquidation, something went under belly up and they want to liquidate. Or they're just liquidating old assets, right? Scrap. So that's the purpose. You have to understand the purpose, and we'll understand later why the purpose is important in determining what approach and method to use. The third thing is called the premise of value. The premise of value is the underlying assumption of the asset, right? Is the asset that I'm looking at, is it achieving the highest and best use? Or is it, I'm valuing it based on an existing use? Or is it an orderly liquidation or a forced liquidation? Each one of those premises would determine, again, the value and the method used and the value obtained. And these 3 things lead us to the next 3 things, which is the basis of value, which is VPS 4, if you guys remember. The basis of value is there's market value, there's market rent, there's equitable value, which is not written here. As in the standards, there's synergistic value, which is also known as marriage value. There's liquidation value, and there's investment value, among other values. Once we determine what the basis is, then we can decide what market approach we can use. So the approach would be, there's only 3 approaches: market, cost, and income. And then from those are the basis of the 5 methods of valuation recognized by the RICS. So the first method is comparative method. The second method is the DRC, which is the depreciated replacement cost method, or otherwise known as the contractor's method. There's called the investment method. The investment is 2 types. There's the traditional, and there's the DCF, discounted cash flow. And then there's the profits method, and then there's the residual method. So this is the framework. This is the methodology, valuation methodology framework, according to the standards, the RICS and the IVS 2017. Now we'll dive deep into every one of those. So the first thing you have to understand when you take an assignment, when you take an engagement, is what type of asset is it? Is it land? If it's land, is it an empty plot of land? Is it a land for development? Is it agricultural? Is it factory? What are the permits on that land? Is it reclaimed land, etc.? Right? Why does that matter? Because every one of those, if you have, for example, a non-reclaimed land versus a reclaimed land, then there's cost that was involved in reclaiming that land. You might have to factor that in when you look at the comparatives. When you look at a piece of land, you might also say if it's agriculture, is it developed, like there's plant on it, it's producing, or is it it's not producing, or it's not able to produce? Is it used for development? And what's the highest and best use for that land? Right? What are the permits on it? Is it going to be a commercial project that's going to be built on it? Is it residential, etc.? So first you have to identify from the type of asset how it's going to be used. It's going to be used as residential, whether it's units or land, commercial, specialized building, or plant and equipment. So if it's residential, is it owner occupied? Someone who's buying it or selling it, is it living in it? Or is it going to be used as an investment? is going to lease it, right? If it's going to occupy it, you can clearly, can you guys still hear me? Yes, excellent. So what's the difference? Why does that make a difference? If someone might ask, why would a residential unit, why would we care if it's owner occupied or it's leased? Well, if it's owner occupied in many countries, then you're looking at market value in the form of comparatives, using the comparative method, for instance. You're comparing assets being sold, bought and sold in the market. Versus if it's leased, then it's probably an investor, a real estate investor. So you're looking at an income stream from the rent, and therefore you use an investment value, not a market value. In which case you would use the income approach, right? So understanding again the type of asset and how it's going to be used will affect the rest of your framework later, the choices that you will be making. Same thing with commercial. Are those commercial properties, are they leased, like they're retail shops and offices? Or the commercial properties operating, like it's a hotel or a hospital or a cinema or something like that. Again, why does that matter? Because it affects the method and basis of value that you're going to be using. Is it a specialized building? Are you valuing a government building or a house of worship, like a church or a mosque, museum, a stadium? And are you valuing the plant and equipment, which is essentially factories and manufacturing production lines, warehouses, etc. Right? So those are some type of assets. I mean, this is just a broad example, but you guys can be creative and you can think of all kinds of things. I got a question the other time. What about how do you value the Eiffel Tower? Right? It's very likely a specialized building. Francis, you might want to square with Dine, send her a private message and see if you can fix your audio problems. So that brings us to the second step. So now you understand what the type of asset is. Now we have to understand what the purpose of the valuation is. So you have to always review in the engagement, first what the property to be valued, always review that. What is the interest that's being valued, right? Is it full interest or is it a majority interest or minority interest, controlling interest? Why does that matter? Because there are different values for the interest that you're being valuing. And then the purpose is the answer to the question why. Why do you need to value it? Is it for purchase and occupancy? Is it for purchase and renting out, letting? Is it for equity release, for loans, for taxation, for insurance, for compulsory purchase? Does everyone know what a compulsory purchase is? Right? It's when the government comes in or an entity comes in and says, I'm going to take this plot of land and I'm going to compensate you for it. Right? It happens when the government has to reclaim land to make up a highway, to make up a new highway, or a new area, agricultural area has been added to a master plan for a new city. So there's a new master plan for the area, for instance. It happens. So the government or the city can come and reclaim and compensate you. The third component is called the premise of value. Premise of value is essentially an assumed use described by the circumstances of how an asset or liability is used, right? So if you have, for instance, a client comes in and he presents a building for you, an old building, let's say it's built in the 50s or something. It's on a plot of land and it's only 3 stories high. And then you go into the inspection and you look at the area around that building and they're all new rises. 20 floors on the right, 24 floors on the left, 20 floors ahead of you, in front of you, and your building is only 3 floors. So you start asking the question, is this old building, is it achieving the highest and best use on that piece of land? Right? So then the question becomes, am I valuing this asset as is? On what basis, on what premise am I valuing this asset? Right? It happens all the time. So highest and best use assumes, for instance, that you're achieving the best that this land can give you. If that's the current use, then the current use is the highest and best use. But sometimes you get presented with valuers, developers will come in and give you a plot of land, and you are supposed to value it on an investment basis. So then you have to assume what the highest and best use is. Or they'll give you something that's already developed, but it's not achieving the highest and best value. So you have to think about that and identify it. And then the other premises are orderly liquidation. What is an orderly liquidation? Is when you have enough time to liquidate the asset. So let's say a factory or a business goes bankrupt, and you have to sell, but you're not forced to sell at a short amount of time. They take time, and you can advertise for it and so forth. And if it gets a good price, you will sell. If it doesn't, it's just sitting there. Unlike a forced sale is when it may be that a bank will come in and this asset was used as a collateral. They'll come in and close on they'll reclaim the property and put it on an auction. So the owner has no say in whether it sells or not. It's a forced sale. Just an example. It's not the only way. So understanding the premise of value will then affect the actual value of the property. Right? When you value a property that is, for example, achieving highest and best use, you're looking at, for instance, the investment value or the market value. But when you are valuing an asset that's under forced sale, then you may be looking at the liquidation value. So that is the basis of value, right? The basis of value is determined from all the previous questions. A common question is, what is the most common basis adopted for valuation of property? Right? The most common basis is market value. Most people ask for market value unless the answers to the previous questions give you a different answer or give you a different conclusion, right? But most of the time it's market value that you're looking for. But if you go into a client gives you, for example, a factory or a hotel to value, and then you go in there and discover that that hotel will get demolished, and you're supposed to value that hotel, then there's no point of valuing the building. You're just valuing the land on a different premise, on the highest and best value, right? Or you're called into a factory and you're supposed to value a production line, and the production line has essentially finished. It's complete. It's completely depreciated. It has achieved its end of useful life. Then it's just a scrap value, right? You're looking at liquidation value at this point, not a market value. The market value is the liquidation value in other sense. So basis of value essentially is determined by what is the type of asset, what's the purpose of the valuation, is it achieving highest and best value, what the premise of value is, and then you determine what the basis of value are. So according to the VPS 4, again, which is in the RICS Global Standards 2017, the basis of value, which are recognized in the standards, are market value, market rent, investment value, which is also called worth. If you guys remember the first slide where I said there's price, cost, value, and worth. So investment value is, was it worth to the investor? Something called equitable value. Equitable value is also a special value. Synergistic value, which is also called marriage value. And then a liquidation value, which is associated usually with a forced sale or a orderly liquidation. So the basis of value is for the member to determine for every valuation. It's your responsibility as a valuer to determine what the basis of value is. And there are two bases of value most commonly used in residential property valuation, namely market value and market rent. That's for residential, for instance. Right? So everyone should know what the definition of market value is. So the estimated amount. So again, it's an estimated amount, estimated price, for which an asset or liability would exchange on the valuation date between a willing buyer and a willing seller. not a forced buyer, not a forced seller, at an arm's length deal, meaning within reach, after proper marketing, and where the parties had each acted knowledgeably, prudently, and without compulsion. So a market value cannot be, liquidation value cannot be a market value when it's a forced sale. A synergistic value cannot be a market value because one of the willing buyer, for instance, or the willing seller, um, has a vested interest, extra vested interest in that property, right? There's, for example, a school that needs to expand. So the land that's right next to that school is worth a lot more to the owner of that school than it is to the rest of the market. That's called a synergistic value. It's no longer a market value. It's worth more a lot to him than the rest of the market. So you have to identify those scenarios, right? When you're investigating and you're doing sort of a desktop review of the asset that you're reviewing, you have to understand what the story behind it is, and therefore decide what kind of basis of value, what kind of approach and method to use. So VPS 5 in the RICS standards excuse me, talk about the approaches and methods. So now we've switched from basis of value, which was in VPS 4, now into the VPS 5, which is valuation approaches and methods. So it's actually in the standard, it's written down that members are responsible for adopting and, as necessary, justifying the valuation approaches and evaluation methodologies or methods used to fulfill an individual valuation assignment. And that's actually a requirement in your reporting to justify, adopt, and explain and justify. So these must always have a regard to the nature of the asset, so the type of asset or liability, to the purpose, so we discussed the purpose, the intended use, right, and the context, so the premise of value of the particular assignment, and to any statutory or other mandatory requirements applicable in the jurisdiction concerned, which is something we will call local knowledge. We'll talk about that in a bit. Members should also have regard to recognize best practice within the valuation discipline or specialized area, or the specialist area, I apologize, in which they practice. Although this should not constrain the proper exercise of their judgment in individual valuation assignments in order to arrive at the point opinion of value, which is professionally adequate for its purpose. So you will be exercising your judgment at the end of the day. Valuation is a subjective exercise, but it has to be based on standards and well-known best practices, right? That's the whole point of a standard, is that it is a best practice manual. And for those of us who are registered valuers where we get audited, we always ask whether we have followed the best practices throughout the valuation process, including, obviously, but not limited to, choosing the approach and method and the basis of value, which we talk about today. So, unless expressly required by statute or by other mandatory requirements, no one valuation approach or single valuation method necessarily takes precedence over the other, right? And in some jurisdictions or for certain purposes, more than one approach may be expected or required in order to arrive at a balanced judgment. In this regard, the valuer must always be prepared to explain the approaches and the methods adopted. So this webinar, the whole purpose is to be able to answer that question. You should always be prepared to explain the approaches and methods used. And to do so properly, you have to understand all the previous things that we've mentioned, the type of asset, the premise of value, the purpose of evaluation, and the basis of value. So what are the approaches then? Right? The approaches again are, they're mentioned in VPS 5. There's the market approach, there's the cost approach, and there's the income approach. And those are the basic approaches and these are the foundations for the 5 valuation methods. So the market approach is typically tied to the comparative method or the market trend, market value as a basis of value. The income approach is typically tied to the investment method or the profits method, and is tied to the investment value or the synergistic value or the equitable value as a basis. And the cost approach is typically tied into the residual method and the DRC, depreciation replacement cost method. And usually the value that's being produced is a cost, which would represent the market value. So you'll be asked over and over, for those who are candidates and for those who are still aspiring to become valuers, what are the 5 methods of valuation recognized by the standards, right? So the 5 are the comparative method, the DRC contractors, DRC or contractors method. DRC is depreciated replacement cost method. The investment method, whether traditional or DCF, the profits method, and the residual method. And then you'll also be asked, when are they being used, right? So the comparative method is typically used, we'll discuss that in details. But you can already guess where I'm heading with that. So in VPS 5, which is in the standard, the valuer, which is the member, you, must choose the appropriate method of valuation to fit the case. You have to understand the case. You have to choose the appropriate method. The choice is obviously a matter of professional judgment, but again, you have to understand the standards in order to make a professional judgment. You have to be well trained. And you have to obviously make provisions for local or national circumstances. What does that mean? It means that, in some countries like Ethiopia or Hong Kong, land is not owned, it's leased, or there's a user's right, for instance. So you have to take care of those things. So what is the market value for a land that is being leased by the government? And be prepared to explain and justify your choice. So the VPS 5, which is in the RICS Global Valuation Standards 2017, corresponds to IVS and International Valuation Standards 105. So if you open up the 2 standards, International Valuation Standards and RICS, they complement each other, of course. And you always see there's parallels in numbers. So VPS 1 is 101, VPS 2 is 102, and obviously VPS 5 would be 105. So just note to be clear, the RICS standards are not prescribing the valuation approach and methods to use. They're just setting up the expectations. That's what a standard does. Puts a definition and an expectation. The prescription is up to you. You have to understand all the previous components, and you have to be able to make a professional judgment. So the RICS expects members to be responsible for selecting and as necessarily justifying both the valuation approach and method according to the circumstances of the individual valuation assignment. The IVS 105, which is equivalent to VPS 5, the actual term, it says the goal is selecting valuation approaches and method for an asset is to find the most appropriate method under the particular circumstances. Sometimes, on occasion, a particular approach or method may be specified in jurisdictional legislation and then becomes mandatory. Otherwise, the VPS 5 does not prescribe. Indeed, RICS would be most concerned to find that members were not properly exercising their own judgment in relation to individual valuation assignments. So, if you're being a registered valuer and you depart from the standard, there's going to be an issue and you might have to be able to defend that. So the RICS, there's a confirmation that the valuation has been undertaken in accordance with the international valuation standards and that all significant inputs have been assessed by the valuer and found to be appropriate for the valuation provided, or the confirmation that the valuation has been undertaken in accordance with the RICS Red Book, which is more formally called now the RICS Valuation Global Standards 2017, which incorporates the IVS. In both cases, the valuer should include a note, an explanation of any departure from the standards, whether it's the RICS or the IVS, And the statement of compliance should draw attention to any departures, right? So statement of compliance is something that's in Professional Standard 1, which we are not talking about in this webinar, but attention is drawn to the fact that in cases where the departure is made that is not mandatory, it will not be possible to confirm compliance with the ideas. So if you depart from the methods that I'm describing in this webinar without proper justification, without, for example, local mandatory legislation forcing you to do so, or proper justification because of special assumptions, then you're going to be facing an issue with liability, you're going to be facing an issue with compliance. So let's dive deeper into the 5 valuation methods. So the first one is the comparative method, which is, when would you choose the comparative method? We'll come back to that. There's called the investment method, which is both traditional and discounted cash flow. The residual method, the depreciated replacement cost method, which is DRC for short, and the profits method. So those are essentially the framework, the methodology framework to summarize. So we have the type of asset, the purpose of valuation, the premise of value, the basis of value, then the selection of the approach, and then the selection of the method. Let's talk about the first method, which is the comparable method. The comparable method is typically associated with the market approach, right? So the market approach usually uses the comparable method. Why is it called the market approach? Because it uses market comparables. What would the market do? What would the normal buyer and seller do? And therefore, the basis of value is typically the market value. What would the market say about that value, according to the definition that we've stated earlier? So the comparable method, also otherwise known as a sales comparison method, relies upon the basis of substitution, right? So the principle that a purchaser pays no more for the property than he would otherwise pay for an equally desirable substitute property. There's an open market, there's demand and supply. These sort of the prices have commoditized, so there's a regular price. That is it's not special. Obviously, it requires that you analyze similar properties, that the market has plentiful of transactions. It's a functioning market. It needs interpretation. You have to always do adjustments, influencing factors, right? So for example, if you're looking at a house, is that house overlooking a lake? Is it on a main street? Is it on a quiet street? Does it have extra rooms? Does it have a garage? And the markets are always local. So when you get an evaluation assignment, you have to look at the local comparatives. You have to look at the local market. Even if the buyers are international. So even if that asset is being traded on an international scale, international market, the market for the asset is local. So the comparative method, or the comparable method, it tests for you have to do tests for the comparison approach, right? You have to make sure that there's a sufficient number of comparables. It has to be comprehensive. They have to be very similar. I mean, if you're looking at a residential property, you should not be looking at comparables that are commercial or that are factories or anything similar. You have to be essentially, if it's residential, looking at residential. If it's a house, you're looking at a house. If it's a flat, you're looking at flats. If it's a high rise, you're looking at high rises. They have to be very similar, ideally identical, but in style and condition and everything, but obviously it's very difficult to find identical properties, but the closer the better. The sale or the substantiation should be recent, so you're not looking at sales that occurred 20 years ago or 10 years ago. You're looking at something that's most recent, preferably if it's on the market and there's an offer that's on it, then that would be the highest level of comparable. And we'll talk about the hierarchy of comparable evidence in a bit. It has to be verifiable, so you have to be able to substantiate it by a contract, by an offer, by a registry. And the evidence is consistent with the local market practices, right? So if in your country or in your region, a retail shop is being traded on a sales and leaseback assumption, then you have to use comparatives of the same nature. But in the same shop, the same retail shop in another country could be on a market value on a buy and sell basis. So you're not using a sales leaseback assumption, for instance. So it has to be consistent with the local market practices. So in that local market, that asset is being transacted in a certain way, and that's the market norm. The second approach is called the income approach, and there's two methods, right? There's the traditional method, and then there's the DCF. The traditional we'll talk about in a bit, and the DCF is called the discounted cash flow. So the traditional method, when do you have to choose between the two? Well, the traditional method, or the capitalization of yields, is being used typically when the income stream is identified or is stable in perpetuity, right? So you have something that's already been developed, um, like a residential apartment, and it's rented, right? Or a shop in a mall that's already functioning. It's already in the market for a while, and it's been renting in and out. And the traditional method essentially uses the relationship between the rental income and the market value or the capital value. And then you have to determine something called the all risk yield. So the all risk yield is it takes into account future rental growth, and the yield should also reflect the risk in the market, right? And freeholds essentially are valued at perpetuity. So the freehold is going to be owned for infinity until it expires. So the leasehold valuations reflect duration in terms of the lease. So this is more details into the specifics, but in essence, the concept is there's a relationship between capital value, yield, and rent or the income, right? So the capital value is known when the capital value is known. So when you know what you purchased this property for, the necessary income can be calculated from the yield, right? So the income per annum, PAs per annum, is the capital value multiplied by the yield, or the rate of return in that case, which is the reverse of the yield, and then you get the income per annum. Or the opposite, so for instance, if the capital value is $100,000 and the required rate of return is 5%, which is all risk yield, right? Then the income per annum is just $100,000 multiplied by 5%. Then you should be getting $5,000 per annum. That's your income. That's your valuation right there for rental income, right? The opposite is also true. So when calculating the actual value of the investment, and this is mostly what we do, where the income is known or is anticipated, you know what the rent is, the market rent is, then the same formula could be applied in reverse, right? The capital value is the income per annum multiplied by the inverse of the rate of return, or multiplied by the yield, right? So you get the capital value is equal to, for example, you have $5,000 per annum, and the required rate of return is 5%. Then $5,000 divided by 5% is $100,000. So the relationship is the same. It's just a multiplier. So in essence, the year's purchase and yield. So year's purchase, there's another concept also that's being used. YP, this year's purchase, is essentially the reciprocal of the yield. So as long as two of the three factors of income, value, and yield are known, the third can be calculated. So the year's purchase is essentially the multiplier. You often, in the market, you come into a rental property and he says that's a 10x property. 10x is the multiplier, the year's purchase, meaning that it rents out for 10% of its value, current value, purchasing value, right? So YP is essentially the 10x. It's literally the number of years income is represented by the value or the purchase price of the property. So when you have one, you can always find the other. And the yield essentially is the number of years. So YP is the number of years it would take for the annual income to pay for the purchase, right? And for perpetual income, right, for a property that's freehold, for instance, the multiplier is essentially the reciprocal of the yield. So if the yield is 10%, the multiplier is 1 over 10%, which is 10, and so forth. 8% yield is 12.5 YP. 5% yield is 20% YP. Are you guys still with me? All right. So the question becomes, okay, where do I get the yield and where do I get the capital value? And all right, I'm being asked by a client to value a retail shop. How do I value that using an investment, okay, traditional investment method, right? Well, the question becomes again, you have to get some evidence, right? You have to get comparables. Comparables of what? Comparables of rent, for instance, for the same retail shop in the area. You have to adjust for that. Or you have to get comparables for selling, what the capital value, how much does it sell in the market? Again, from other evidence of selling. If you divide that market rent by the market value, you get the yield, right? So if you get one or the other, or the yields could be known. For example, there will be market research that says this area, the yield is 7% or 5%. So if you already know what the yield is from either previous knowledge or by comparables or by databases, whatever you subscribe to in the area, then you can just get the market rent, determine what the capital value is. Or you have the capital value, determine what the rent is, market rent is. So the method requires evidence to be obtained. Comparables of let and sold property, let meaning rented and sold property, might provide this. But then you have to sort of adjust for it. Location, tenants, demand and supply might affect the anticipated yield for a specific area, for a specific property. You have to factor that in and justify it. And rental evidence might require adjustment. Asking rents and passing rents may vary significantly, so you might have to adjust for that. So if you look at a rental lease, for instance, that's been signed 5 years ago, it might not be equivalent to today's market rent. It might be higher, might be lower. And then the risk, obviously, of the void periods of income needs to be taken into account. So, a property could be renting for $5,000, but there's an occupancy problem, right? 3 months on average every year is unoccupied. So you might have to factor and adjust for that as an annual revenue, right? So you have to come up with something also concept called the net rental income. So net rent is essentially after you take away, so you take the rent, for instance, you take away the building repair and maintenance, the management expenses, the building insurance. We always work on a net rental income. We don't work on the revenue, we work on the profits. That's very important distinction. The second method of the income approach, the investment method, is the DCF method, the discounted cash flow. And for those of you who know finance, discounted cash flow essentially is, let me skip you can read the slides later because of the time, but this DCF valuation, essentially, you have to factor in the income per year. So for example, you spread out in the Excel file your income, your costs, the anticipated costs, your terminal value. Your terminal value in the end essentially is just the traditional method. I think the slides are stuck, Dine. There seems to be a problem with that slide. Okay.
Tarek?
Yes.
So, are you on 24th?
I think I am on 34, but it's not showing. Okay, well 32 is showing.
Let me just...
I think it's loading slowly.
32.
Yeah.
This is 32. 33.
And then 34. Yeah. Okay, now show.
This is 34.
Yes.
Okay.
So 34 is just so DCF. So everyone's familiar with the DCF. Anyone here has a financial background, banking or financial valuation? Maybe you can say I this time instead of yes. But, yeah. So for those who are familiar with that, it's just a typical DCF. So for a property, You would plot out its income stream. You will plot out its costs. The difference between them is the free cash flow. And then the terminal value in the end is essentially the capitalization on the stable. So once it becomes a stable income and a stable um, cost, then the difference between them is there's called a terminal value. And the terminal value is essentially capitalization. Again, it's yield and divided by, or the capital value divided by the yield. So in essence, this is discount cash flow. When would you use the discount cash flow? Is when your property is not stable, or when, for instance, it's still a new property, there's still an occupancy rate curve, a growth curve. It has not reached yet perpetuity, infinite perpetuity rates. So this is when you would use a DCF. So for example, if you have a new project that's coming up and the occupancy in the first few years is 35%, 50%, 70, 80, then it becomes 80, 80, 80, 80. Then you can say, okay, at the 80, I put up terminal value at year 5, and then do a DCF, a net present value. I recommend, how would you decide between a 5 or a 10 or a 15-year DCF? I think this is a very important question, and it really depends on the discount rates that you're going to be selecting, or in the area that you're actually doing the DCF valuation. If the discount rate is too high, then it's typically unreasonable to go beyond 5 years or 10 years, right? Because diminishing returns, right? So if you're doing your valuation, you might want to consider the market norm, or what the conditions of the valuation and the income approach for your market is. For example, in Egypt, we use a WACC, a weighted average cost of capital, in real estate of 20%. 20% is ridiculous. That means after 5 years, your value is, or whatever values that you're producing, is only 1/30th of its value today, net present value. So it's ridiculous to go beyond 5 years. In the US, for instance, the WACC could be 2% or 3%. You can really run into 15 years very easily, and you still find some value at the end. So I think for those who want to understand how the income approach works, there's a lot of courses on that, very, very detailed. We do some training in the RICS Academy for that, but it's very, very involved. It's very important for you, the beginners, to understand that it exists and how it works. But this is a very involved method, and it takes a lot of assumptions, and there's a lot of verification behind it. The third method is the residual method. So the residual method is also known as development method. Is used to arrive at the capital figure of the land for which the property stands, or for something that's not achieving the highest and best use. So for instance, if you have a villa that's being built on the sea by the Dubai Creek, for instance, and the buildings right next to you are all high rises. So this villa is not achieving the highest and best use, for instance, you've decided so. Therefore, when you do a valuation, it's ridiculous to use a market comparable. Okay, there's no market comparables for villas in the area. So you might want to be using the residual method. So the residual method is you assume that the building is built, the high-rise building is built, and then you deduce the cost that would achieve to arrive at that market value, and then whatever the difference between them are, that's the value of whatever is the property that's in your hand. Does that make sense? So the residual method, or the development method, there must be a potential for the land to be put at a higher use value, right? So there has to be a higher use than the one that's existing. And then the land values, for example, for land valuation, are usually arrived by sales comparison, but the residual valuation may be used as a check valuation. It could also be used when there's no comparable evidence, and it requires a bunch of assumptions, right? And it's also the logical way that the developer works. So if the developer comes and says, please value a piece of land or a building that's not achieving the highest and best use because I'm going to demolish it and build a higher rise building, you typically use the residual method. It's also used for development appraisers. It's the same. It's the residual valuation is used for development appraisals, right? So you do a development appraisal, and then you deduct, you come up with the residual land value, the RLV, for instance, or the residual property value in that case, if it's a property that's not demolished yet. So the stages are typically establish the potential for the development in the area and the local market, assess the value of the completed scheme, right? Calculate the development costs for the scheme, include the profits, and then deduct the costs from the completed value to arrive at the residual value. So the question is, would you discount income flows in a residual model? Absolutely yes. So if you use a DCF for your residual model for development appraisal, then you definitely discount it. Right? So you could do it. So if the valuation takes, so if the development is over 4 or 5 years before you realize incomes, then you absolutely have to have. And then depending on what kind of property you're building, so if you're selling off plan, if the property that you're building is to be sold, then you might already be realizing income from the very first year, right? Down payments, you know, installments, and so forth. You might want to factor that into your DCF for the residual value. Or if it's like a mall or a hospital, where it's only going to start realizing income after it's fully developed, then obviously that these income in arrears should be discounted to present value. Yeah, a lot of valuers use bespoke solutions. They don't necessarily have to use Argus Developer, but Argus Developer is, for liability reasons, registered valuers have to use it and then adjust for it. But that's a different story. That's a very advanced question. But typically, what is the expected value, which is the residual value? It's essentially, for example, the value of the asset, the highest and best use, which is you can determine that from market value using comparable methods. When that building is being built, how much will it be sold for? Or from the rental income, which is rental income divided by yield, which achieves the capital value at the time of completion, minus the development costs. You would get the residual value. So you can also use the income approach, the capital method. So the residual method combines a bunch of other methods, incorporates a lot of other methods inside. So an example, you have a building, you have a piece of land that's going to be developed into 20 flats. The flats market value is $250,000. You multiply 20 flats by $250,000, you get $5 million. That's the value of the project when it's complete. And then you analyze the cost, the demolition, construction, professional fees, etc. It comes up to $950,000. The profit is, on top of that, is $600,000. The difference would be the difference between $5 million, which we pay for, and the $4.4 million, which is the cost of development plus the profit, and the residual essentially would be $650,000. I'm assuming all those numbers are present value. Other valuation methods, there's the DRC, which is also known as the contractor's method, which is the depreciated replacement cost. That can be used when there's no real market, right? There's no comparison evidence, and the income capitalization cannot be applied. And it's also generally for specialized properties like oil refineries, power stations, government buildings, mosques, museums, stadiums, things that there's very difficult to measure using comparable methods. We don't have a stadium being sold every day, and the income per stadium really is very dependent on many other factors. It's not really easy to compare apples to apples, for instance. And then the profits method is a very advanced, weird method of valuation. It's not very commonly used except for hotels and hospitals for operating property, and it's a very specialized method. It's used for specific business income producing property, and there has to be benchmarks to be used. And these are used typically, the profits method is typically used where buildings are solely used for the purposes of a business, like again a cinema or a hotel. And there has to be a good understanding of the normal income and expenses associated with that business. Otherwise, you would use the income approach, the investment, the DCF method, right? So, pop question: how would you value a mosque or a ministry or a public utility? Would anyone answer what method would you use? Would you use the market approach? Would you use the income approach, cost? Would you use the comparative method, the DRC, depreciated replacement cost method? Cost approach, absolutely, the DRC. Why? Because those are specialized buildings. right? So the depreciated replacement cost method is used in the absence of comparative sales evidence. It's normally applied to specialized properties where there's no general market, for example, public buildings, mosques, government buildings, etc. And it's based on the thesis that the value to an owner can be estimated by reference to the cost of suitable replacement premises opportunity cost for the premise less any depreciation. Why depreciation? Because you have to depreciate the asset, obviously. It's not brand new. But the cost is not value. Remember that. I'm going to skip the example, but I think you get the idea. How would you value a cinema, a petrol station, or a hotel? What are the two possible methods to use? Does anyone know? Profits method, absolutely. Right? Some people would argue that you would use the DCF method, which is also valid. But the profits method is typically what you would be using. And essentially, you have to understand the balance sheet. You have to understand the normal, what we call the benchmark, the normal operations of those hotels or cinema, and it's usually by unit, so by keys, number of keys for hotels, or by number of seats or movie theaters in a cinema. And then there are certain ratios that are typical of the market, also using comparables. You have to get the market benchmarks, and essentially you can derive what the valuation would be, also using the capitalization approach of the profits, right? Again, those methods are a bit advanced, and examples are provided in more advanced classes. And I strongly encourage you guys, if you're interested, to take specialized courses in all of those methods. This is just an example of how you would get a net profit. Obviously, everyone understands what a net profit is, I hope. There's a gross profit is the gross earnings minus the purchases, so the cost of goods sold. And the net profit is essentially the difference between those profits and the operating expenses or the working expenses. CU here is currency unit, just a generic one. Obviously, the advantages and disadvantages of the profit method is that the advantage is that it's applied on unique property when it's not suitable to generate enough comparable information. And it's applied on property that has lots of unusual or unique characteristics, has differing profit generation characteristics like hotel and cinema and so forth. Disadvantage obviously is requires operational business current money. The business has to be operating, right? It has to have some data on it, operating data. And also, this advantage is absence of rental evidence creates a risk in the rental value if it cannot be estimated properly. So there's a bit of risk with the profits method. Hopefully by now, we're at the end of the topic session. You should have understood how the three valuation approaches, the market, the cost, the income approach, and the methods, the 5 methods, right? The comparable method, the investment method, the DRC, depreciated replacement cost, the profits method, and the what would be the fourth one? Would be the residual method, right? What they are and how they're used. What specific valuation approach is best suited for which assets? So residential, if it's owned, then it's typically a comparable method, which is a market approach, which uses the market value. If it's for rental, then it's usually the investment method, the income method, income approach using the traditional income method, the investment method, using the basis of value would be the investment value, and so forth. If you're valuing a specialized asset, there's usually a market value using the DRC method, which is a cost approach. If it's a property or a land that's not achieving highest and best use, then using the residual method, which is a hybrid income cost approach. And the basis of value is either investment value or market value. Does it make sense? So you should be appreciating the relationship between the purpose of value, the basis of value, the approaches used, and the methods used. And have a good understanding of the RICS standards, so the VPS 4 and the VPS 5, what is required of you, what is expected of you, the issue of justifying and explaining why you should be using a certain approach and a certain method, and what basis, and based on what premise, based on what purpose, and be able to assess the merits of various data available in the valuation approach and method. So the data given, what's the type of property, it doesn't have income, is it being sold, is it being rented, what's the local practice in the market, and essentially appreciate all these sort of factors in deciding what the appropriate method and approach should be. And by that, I think I conclude today's session. There should be an image of a question mark. So, Diane, how much time do we have for Q&A?
We have 30 minutes for question and answer, and I'm sure you will have a few questions. Now you can see that we've moved our window to the question and answer. You will find a poll. If you can help us
So
with the survey of any topic that you, yeah?
So I see already questions coming in the chat window. So.
Yes. So just please make use of the chat window. This is where we need to type in our question, and Tarek will read it and answer it accordingly.
Okay. So I see a question coming in from Hassan Adnan. The question is how to value the leased land from government. And the less garment is about 25 years. So I'm not quite sure what the less garment is. Oh, less. Okay. The leased garment. Okay. Is about 25 years. Okay. So I think by garment you mean the lease agreement, or it's about 25 years. So so that's a question for every one of you. What would you think? How would you use, what approach and method would you use to value a leased land from government? Exactly. Exactly. So one method. So under which circuit? So Matthew is asking. So that's the same question, or this is I don't think that's related to Hassan's question. Under which circumstances the market value different? Yeah, we'll address that in a bit. So for Hassan, you definitely use one way of doing it is using net present value. Absolutely. So if you have direct comparison, so leased lands, let's say the circumstances of your market, for instance, you're in Hong Kong or again Ethiopia or so forth. No land is owned. All land is usufruct, is traded by the government. So it's very easy to find comparables, right? You would look at the land right and left in the area and see what the going rates are for leasing land for a specific period of time. But let's assume, so use a market approach, the market approach using market rent, for instance, to value the market rent. If you want to obviously capitalize the market rent over 25 years, then you would definitely use a DCF approach, but there's no terminal value in the end, no cap, no capitalization in the end, which is what Hashim, I think you answered your own question, or Hashim? No, Hashim is a different person. Absolutely. So you just do a DCF, net present value, and all the free cash flows, right? But let's say you're in an area or you're in a country where that's not the norm. It's a very specific asset. So how would you determine what the fair market rent would be for that land, or what the usufruct value would be? And there's different answers to that question, right? Is that land being leased so that you can develop? Is it a BOT? Is it built to operate transfer? So you have to factor in some development costs and operations on it. Typically, would use a residual land value approach, right? So you would typically use a hybrid between DCF and residual land value or development valuation with a no cap in the end, right? Typically, that would be the answer. Does that answer your question, Hassan? Let's answer the next question. Under which circumstances is the market value different to the fair value? So that's a very good question. So fair value, according to the IVS 2017 and according to the RICS 2017 standards, fair value is market value. All right. So the word fair value is the IFRS standards uses that term, and in the IVS it recognizes that as market value. But there's fair value is a little bit wider in nature than market value, because what's fair depends on the premise, right? So it could be the fair value would be the market value. It could be the investment value, so the equitable value for a specific investor. But in an exam or in a test or in an audit, we do not use the word fair value at all in the RICS IBS, because it's exactly the same as market value. So Claire is asking, what is the purpose of the valuation? Is that specific to, is that a question to someone? Or is that to me? And Hassan is saying mortgage. Okay, so I guess you're talking to each other. Okay, so I might be butchering that name, Luchimi Chinai. I apologize for that. Can you please give a few questions that can be asked in a final assessment interview concerning the 5 methods? You'll be getting a lot of questions. When would you use a certain method? What is the best methods used for a residential property valuation? What is the premise of value for market value? All kinds of questions. If you have a multiple choice question, it's very common that you will be given a statement, and then you would choose true or false or something, or choose among 4 different choices. So Hassan, again, any person in my country can get leased land from the government in serious project and have a serious project. Okay, that's good. Your country, I assume, is what? Is Jordan or? Adil Chowdhury is saying, is there a benchmark to calculate forced sale value or discount depending upon the market period, and should be mentioned as value under special assumptions? Yes, absolutely. So is there any benchmarks to calculate? There's a local benchmark typically in your area. If there's no benchmark, you can always find comparables. If you cannot find comparables, then you have special assumptions that you have to make. So typically, the go-to strategy for any valuation is finding comparables for any of your assumptions. So if you're doing a forced sale value, then you want to know, for example, how much usually does a forced sale sell compared to the actual market value in that country. For example, I talk about Egypt, for instance, a forced sale, if it's offered by a bank, it's usually 20 to 25% below market value. Why? Because there's all kinds of fees and taxes and expenses that go into it. So anyone who's going into an auction for a forced sale should assume that a liquidation value is 25% at least less than the market value. That's just the benchmark used in Egypt, but it could be otherwise, proven otherwise. Shanu Jalaluddin is asking, is forced value mandatory to mention? In Oman, banks require forced value about 75 to 80%. So it's very common, yes. You have to mention, obviously, in any valuation report, you have to mention the purpose of the valuation, the premise of value, the basis of value, the approach used, and the method used, and justify the method if it's a departure from normal practice. So personally, in my valuation reports, I mention all of the above in every single report. So which approach can we use to value embassies? Again, what do you think? What does everyone think? So Hassan says cost. So why do you assume so, Hassan? Because it's a specialized building? Because Hassan says it's a specialized building. Adil says depends on the type of property. What does that mean, Adil? Does anyone else have an opinion? Okay, meaning specialized. Okay. So absolutely. It all depends on what an embassy is, right? So if an embassy in my country, an embassy is just an office building in an office floor in a building. right? Some of the embassies operate out of an office building, so that's just an office building, right? Some embassies operate out of their own building, right? They build their own villa or their own compound, in which case it's a very specialized building and you can use a DRC. In some countries, an embassy is actually just a regular villa, not necessarily a specialized villa that looks like the villa next door, and they can buy and sell those. So